The market may get rid of these differences if these errors are weakly correlated or uncorrelated. So that's the key, in my understanding. Very simple. So now I'm going to look at some situation where actually I'm going to show you when you could have individual risk-averse people, but the market could be risk-neutral. That's another point I'm going to make. So it's not necessarily true. You see, if you assume the expectation was homogeneous across all traders, you would get the same outcome. You would get that because there's only one individual, so risk aversion of individual becomes the same as risk aversion of the market by construction. If there's only one person, and that person is the equilibrium of the condition, that's what the mistake of the literature is. They said that person therefore have the same risk aversion as the market. So we try to find out risk aversion of an individual. But the market averages across risk aversion, right? So let's just see what happens. So I'm going to say, let's assume that there is a price of a risky asset at time t is PT. The important key is that that asset in fixed supply. In other words, there's a finite number of shares at any moment in time in the market. And assume traders are risk averse and decide between risk-free and risk asset, the same as what we had before. It's very easy to show that in a mean variance type trade-off, the demand for the asset for the trader I is just a ratio of the expected return. But remember, this expression will not be the same across all I, divided by the coefficient of risk aversion, which is gamma I, and the volatility, conditional volatility. This is the well-known result. If you then impose the assumption that all the demands add up to the fixed supply, solve the model, go through the various algebra, you find that the XX return in the market now is to do with the market, not to do with the individual. It is equal to this expression, which is basically the inverse of harmonic mean of the risk aversion coefficient, which enters the model, but also this effect, which is deviate from the usual rational expectation solution, which is to do with the disparity of agent expectation across I. And the WIT is just the weight, which is 1 over m in this case. So, and you can prove that the sum of the square of the WIs is 1 over m, which is like a granular. Basically, I don't want to bore you with this detail, but basically what it says that it is possible that this term actually goes to 0 when m go to infinity. Because this is a stable, m become large, q is finite, p price is given, this ratio goes to 0, so therefore this risk aversion doesn't play a role in the market. So you have a market with individuals are risk averse, but the market behaves risk neutral. The average behaves risk neutral. And then you could have then the situation that you go to this case. If there's a rational expectation, you go back to the example of risk. The market is the average of the risk of the different individual enter the market. Or if that goes to 0, then you find that when m become large, the expected, this is what we try to forecast in econometrics, become only a function of the errors of expectation of agent, and risk aversion coefficient of no one would enter the equation. These are, again, for what I'm going to show you in a minute, are important because what it's saying that the market behavior is different from individual. This analogy people make, that I look at the representative agent and I look at one individual and I say, how would I trade? And that's how the market outcome going to be, is clearly not right. I plead with a lot of students, please work on these heterogeneous models and try to understand better, rather than just go from the textbook and write down the equation, which basically, this bit equation, say that's a function of risk aversion. In other words, go back to this one. If you had under the rational expectation, you get back to this one. Because there is no error there, and that's what we usually write. So anyway, the bottom line here is that understanding the correlation of traders, understanding that risk aversion in the market is not the same as individual risk aversion. So therefore, this attempt of what's called equity premium puzzle, to try to figure out what is risk aversion coefficient which justify market equilibrium, is a false argument, because there is no reason to be. It's only because of the agent model of Prescott which gives rise to that model. Not because if you had a heterogeneous agent. I challenge anybody to find out what is wrong with what I've just said. So basically, as soon as we allow for that, you also accept that the cross-section average and its behavior becomes important. And it's possible the psychology affects the cross-section average, as I explained. Sometimes become more correlated, sometimes become less correlated. Therefore, sometimes the market looks efficient, sometimes the market may be totally inefficient, looks very inefficient. So it does explain what's happening and what's likely to happen in the future. And I'm going to show you some data. So let's just now, the bottom of all of this line was, in short, markets need not be efficient or efficient, both, at all times. Periods of market efficiency are likely to be punctuated by episodes of market inefficiency. Now you may say, a lot of people, I tell that in the story in the street, nobody says it's obvious. Why do you tell it? Why do you want to make an argument? Why do I make an argument? Because my colleagues still don't believe this. I still assume rational expectation applies to all agents, and those agents all have the same model, all have the same way of processing data. They all arrive at the same expectation. I mean, don't believe me, go and read a few textbooks. Okay? So, however, it's important. This is my view that why you can find predictability, but not all the time. Now I'm going to look at what predictability evidence there is. Let's go now change gear from theory to the empirical data. Let's just look at the data. There are two types of the data which exist, which I can address. One is aggregate data, which is what is the return on some indices. Futures market, S&P 500 or some big index. So I'm going to look at that. So you can do the same with other data. Now, if you believe my argument that there is either assume the representative agent model at the moment and they are risk neutral, or assume there are risk averse agent, but the market become risk neutral for the reason I argued. So therefore, if you believe there is some average risk neutrality in the market, you don't expect any predictability, anything at all. Any predictability would be against the market efficiency and risk neutrality. Okay? That's everybody agrees. Although they say, well, the people are not risk neutral. But as I just argued, you could have risk averse agent, but the market could still be risk neutral. Because I'm not modeling the individual agent. Nobody cares about the individual behavior. We want to know whether the aggregate is that. So if you look at the data, there are three evidence against the market efficiency and risk neutrality together. First, predictability. But any regression, I mean, although people say it's the predictability, the hindsight, there are ample evidence that if you do recursive modeling, the reason why they invited me to work on a hedge fund, because I wrote a paper in Journal of Finance in 1995, which I developed with my ex-student, who is now professor at San Diego, called recursive modeling, to take the hindsight out of predictability. I don't want to go explain what that recursive modeling approach is. Some of you may already know about it. It's the Journal of Finance, 1995, and people have developed it. If you use that model or use any other method, there are predictability in the market. Now, whether you can exploit it, whether it's sustainable, I'm not suggesting that, but there are. So that's one evidence. The second evidence says that if you use a present value condition, that the price-dividend ratio from fundamental value of the pricing, which is I denote by rho here, this price-dividend ratio has to be mean reverting. That's to say that if you believe that the present value condition holds, you get this price-dividend ratio has to be mean reverting. The evidence on that is very weak at best. If you take either the rho or the log of the rho, you can't really reject the unit root in this. Or even if you run a regression or a long period, 1871 to 2009, huge data set, Schiller data set, you can download it, do it, you get the coefficient of the autoregressive coefficient of rho t on its lag rho t is 0.994. If you, if you go up to 12th order, still it is 0.879. So therefore, even if we don't know whether things you can test for unit root or not, those of you know about the lack of power, no way you look at the data is so persistent. It would take ages for it to mean revert. In other words, if you are in a market and you buy an asset and it fails, you may have to wait 50 years before it mean reverts sometime. Who knows? So basically, there is very little evidence that the price-dividend ratio is a good measure of finding out for all assets in general that whether it's going to mean revert or not. taking very long period. I took a long period, but as I said, you could even drop the data from 1948, you get similar answer. The third is that to derive the geometric random walk model of asset pricing, which people use based on from present value, you have to assume that innovation to dividend process are normally distributed. But we know, I mean, the reason is that if you don't assume they're normal and the errors are, say, fat tail, as we know they are fat tail, these expectations do not exist. For example, if you take t distribution, which is the fat tail distribution, if you take expectation of exponential of the t, we know the t distribution doesn't have moment generating function effectively, so therefore the moments does not exist. It was pointed out by Givicki. Again, these ignored in finance. So therefore, if you then, the third evidence is that these anomalies we observe in terms of huge fat tailness goes against the model of the geometric random walk model. So basically, if you take the aggregate evidence at the risk neutrality, if the market was neutral, there is no evidence to say that there is no predictability. There are predictability, although I'm not suggesting all the time. We come back to exploiting predictability in a minute. I haven't talked about whether that predictability is exploitable. That's two separate issues. Now, as I already mentioned, even if you now assume market efficiency, you don't want risk neutral, you want risk aversion, then clearly, if you assume the representative agent model that I mentioned to you and say that the risk aversion coefficient is the same as the agent's risk aversion, then you can't possibly reject the model because it becomes model dependent, because it depends on what model of risk aversion do you use, what utility function do you use. And whatever model I use, you may say, well, I don't think it's the right model. So therefore, in that setting, predictability could be compatible with market efficiency. There's nothing you can do. So therefore, you cannot use the argument that what I just used just now, because the markets are predictable, therefore they are inefficient, you cannot do that. It's only under risk neutrality, you can say predictability cannot be explained by the market. But as soon as you say there are risk aversion, but remember my argument is that risk aversion at the level of individual is not a justification to argue the market is risk averse. Because the market is the average of individuals. And that goes away when the number of traders become large. So my view is that basically, if you look at the market point of view, there is evidence that suggests there are predictabilities. This is what I just said to you, that with Alan Timmerman, we have this paper in Journal of Finance, we look at this kind of model, even risk aversion, we find that there are periods that you can have excess profit made, but it has to be a period of volatility. In fact, when we did this study, we didn't realize that actually volatility is the key, because it was back in 1995, and it became out of the analysis. We found that the period that the model, recursive modeling does well relative to the strategy of buy and hold was during the volatile periods, which by traders like volatility. Okay, this is another argument. Let me now show you new evidence, which I have been working on. I thought we are not going to get anywhere with the macro data, right? That's the end of it. You can develop a lot of models. People say you had a hindsight, your prediction is not worth anything because you knew about the world. Even if you didn't know, didn't try to use your knowledge purposefully, psychologically you know what's happened to the world. For example, if you want to predicting the recent crisis, and even if you put your mind before recent crisis, you know yourself it has happened. So therefore that may psychologically affect the way you do it. So therefore you have no way you could test this independent of totally of your prejudgment. Do you see my point? There's no way you could put yourself outside the world you live in. You cannot do a counterfactual in terms of finding out whether the market was predictable or not, because you already know a lot about the world we live in. So I can see that if you want to use evidence to convince someone who doesn't agree with what I just said, it would be very difficult for me to deal with aggregate data. Just simply, I don't think, I've not written a single paper on that subject for that reason. I realize there's no point. But I think I'm now trying to show you that we have another kind of evidence, which I'm going to discuss with you. It's a new paper I've just finished although it's not released. I'm going back to the capital asset pricing model. We look at individual. Now, I here, I'm sorry to use the same I, does not refer to traders. It refers to individual securities. I apologize for the notational confusion. So these are, but I chose N being the number of them. Suppose there are NT securities at time T. If you don't put this factor, this is the excess return on the individual security. This is the alpha and the beta of that security. This is the excess return on the market portfolio. And this is additional factors. These additional factors have been suggested in literature by Fama and French. I'm going to come back to them. Again, this is a workhorse in finance. So why are we interested in this? Because I can, if I know the parameter alpha and beta, I can use it for many, many purposes. I can price assets. I can make money out of them if there are the alphas are different from zero. So therefore, testing this model and understanding it is the key. It is a mirror image of the macro model. If I aggregate this, you get what I was doing earlier. Right? If I aggregate across I, and then you can find out immediately, say aggregate across all the I in the world, I get back to the market portfolio. If I take it to the other side, solve, I get back that there are possible factors could explain the aggregate market. But I'm not going to do it anymore. I've already discussed the aggregate. Let's look at the individual one. This has been discussed at the literature and been subject to a lot of investigation. You may say, what new do I have to say on it? Okay, what I'm going to do, I'm going to develop tests of alpha. The market efficiency, originally when cap M was, there was no factors here. Let's ignore the F at the moment. The cap M is without F. And the market efficiency is when you test whether alphas are zero or not. But when the people still do the market efficiency test, when I looked at the literature, I found that they deal with it when the number of securities is very small. I explained to you why they do that. Let me just go forward with this. So there is a large literature, but originally Jensen, who first proposed a test of this hypothesis, looked at each security I at the point in time, at one at a time. So we went back to this model, ran this regression for IBM, ran this regression for Microsoft, ran this regression individually for all sorts of assets, and look at each alpha separately, and find some of them were rejected, is more than zero, some of them were zero. So market efficiency here suggests that all the alphas has to be zero, by the way. That's the assumption of market efficiency. Otherwise, if some of the alpha were positive, some of the alpha were negative, as I'm going to indicate a bit later, this is what the long-short hedge fund strategy is for making money out of a stock market. Okay? I'll come back to that. So all the alphas being zero is actually very important, not to be able to make money out of the market. So what they did, it looks at each of them separately. But the trouble was, when you look at all the alphas separately, if you have 1,000 assets, obviously a number of them becomes significant. Then you raise your hand, you say, well, so what? A few of them become insignificant. Then the question is, how many of them should be significant before I worry about it? So that strategy, and this also was inefficient because you look at each security separately, although you knew that they are correlated through the U. The errors could be correlated across I, like a spillover effect. The companies working in electronic, the residual, what we don't explain, could be correlated with each other. There is no reason to believe that's not. So just now, then what did they do? But when the large number, the securities were not large number, as I said, would be very difficult. So what came along was this very important paper by Gibbons, Ross, and Shaken, published in Econometrica 1989, which proposed a test, an exact multivariate version. In other words, instead of testing each alpha separately, they came and said, why don't we jointly test all the alphas together? So if there are 100 assets, we join whether all the alphas together are zero. So therefore, you are not subject to the problem I just explained. That was a successful idea. The trouble was, their test only could be implemented when n is less than t. What is t? T is the number of data points you have. And n is the number of assets you're analyzing. Now, there is a trade-off here. If I took t very large, I get subject to a lot of problems. Like, you know, survivorship bias to begin with. Some of the firms may drop out. If I take T large enough, Enron could drop out. Lehman Brothers would drop out. But all of them are firms you will hold assets. So the trouble is you can't take T too large. Because a structural break and survivorship, some firms, or new entrants. Microsoft came in 1989. So what do you do? If you take 200 years to get very large data, so not viable. You want T short. But if you take T short, N has to be shorter than T. You can't deal with many assets, so you have to select. So what did they do? They looked at portfolios. But portfolio is a combination. I don't explain it to you. It's a combination, but what combination? There are so many portfolios you can construct. It could be that for some portfolio you reject, but there's still many other portfolios you cannot reject. That literature stopped and is struck. So given the work I've done over the last, as I said, on panel, I had an idea. So this idea started to work, and what we found a way of testing N much larger than T. Okay, I don't want to go into econometric details. Why is the case? You have to trust me. We have done it. I presented in Princeton, and I'm going to show you the results. It's really exciting that we can actually do it. Okay, so I found a way of doing it that N large and T small. Okay, this is the test statistics. Okay, just to show off that actually there is a statistic. The idea I had was that, remember this TI, let me say what it is, to give you some intuition to some of you. Not that difficult. The TI, you run an OLS regression. You run an OLS regression of this on this, very easy to do. You get the T ratio of alpha. You get the T ratio of the intercept in this regression. Call it TI. Go back to statistics. So what I'm doing here, I'm pooling these T. Jensen was looking at each T separately. GRS, in econometrica, they will assume all of the errors are arbitrarily correlated. But we know it's not true, because if the asset pricing model holds, the errors have to be independent or weakly correlated, which is called the approximate factor model by Chamberlain and others, those of you know the literature. So that was excessive. You didn't need to do that. So what we do, we just only look at the T, but allow for the correlation by correcting the test statistics. The V is the degrees of freedom. In other words, is T minus the number of factors you have minus 1. V is just the degrees of freedom of the T test. And these are the cortoisos minus 3. Remember, if it's normally distributed, the cortoisos minus 3 is 0. So therefore, we allow for non-normality. We allow for correlation, and we allow for the dimension. We can show that this, when n go to infinity, becomes normal 0, 1. In fact, now one needs n large for the test to work. Okay? It was based on the idea I developed a unit root testing panel, which I used the same idea. So it's not unconnected. You know how it is? You develop some technology, one area, it suddenly finds its way in another area. Okay? So now, see what the results we get. Suppose now I've got the test statistics. I can now apply it to any number of assets. Then what I did, now I can get rid of the survivorship bias. So what we did, painstakingly download the data at the end of each month. In fact, we have data from 1989. The longest data streams can support us. At the end of each month, we downloaded all of the constituents of the SP500. Right? Pay attention to that. We downloaded all of the data. Having downloaded all of the data, then we only picked up those securities which had at least 60 months worth of data, 5 years. 60 is the lowest I thought we could go. But 60 is 5 years. 5 years is too short, relatively short. So that's okay. And then we dropped all securities. The data was some wrong with it, like they had 5 successive zeros in the middle of the sample. We end up with, instead of 500, 475. So we didn't drop many. We repeated the same exercise every end of every month. Okay? Which basically means that what we have totally free of survivorship bias. It's real time. In other words, if you did it at any point in time, you get the same answer. Then we apply the test to all these 470 odd securities we end up having, which are now estimated over short period. So structural instability doesn't play a fundamental role because we took a short period. And then we look at the p-values of this. So these are the data I've just already described. The market portfolio is all the data downloaded from a French data bank, and then these are the additional factors which is used by Pharma French. The value portfolio, this is called the small, big portfolio difference, and the value versus growth portfolio. These are additional factors. We wanted to know how our test, it changes if you added more factors. How robust is the result to a specification of the model. And then we use the market portfolio as large as we could in New York, IMEX, and NASDAQ. Again, it's come from the CRISP data bank. So we're using exactly the same data in there. So then what we get, we estimated the model recursively, 60 time periods each, and tau means that the sample, the number of firms which was in the sample at different times. Remember, they are not the same because they dropped some of them. Run the regressions. These are the p-values. When you get a star variable, when you get stars, it means rejection. These are just some of them because I can't put all of them here because we have lots of them, right? You just see that there are inefficiencies some periods, and you notice here that these are around about, if you just go look at each of them, these are just the end of the year. But within the year also there are inefficiencies. Now then what I did, we found that actually, okay, the market is inefficient in some period, but some other periods is not. The value obviously changes depending on what value you choose to 0.07, 0.01. These are all 2007, 2008, which we would expect to be inefficiencies. Doesn't matter whether you use a CAP-M or form of French regression. And we get it some other periods as well. 1998 is a financial crisis, 1997 here. So basically then, what I did, look at the, just finally finish, we look at now, given the time, actually we found that the majority of rejection are clustered between 2004 and 2008, which is compatible with what we observe about the market turmoil. And there are some differences between the two CAP-M and Pharma French, but generally speaking, then they agreed that these are both models agreed with that. Then what I did, just to promise about whether profitability can be made out of this, so what I did, I said, look, if I were a hedge fund, if I had this regression, I would order them with the highest alpha, most positive alpha, to the least positive, the most negative alpha. I would go long on all the positive alphas, and I go short on all the negative alphas. And I get a long short. I said, well, look, there are long short firms doing this, and the data, and I don't want to look at a particular firm. So what I did then, I calculated the p-values for which we have done over the period that the long short strategy has been in operation. And then we just see, is there a relationship between the return on long short strategies, average, not a particular firm, average, which has been published, and the estimated p-values. So what we did, just to cut the story short, we just look at the Dow Jones Credit Suisse Core Long Short Equity Hedge Fund Index, calculated the return on that. This is available on the internet. Subtracted the S&P 500 to see whether the hedge funds are doing better than S&P. And then plotted the two data, the p-values which came from testing alpha, and the excess return on long short strategy which come from totally different source. What do we get? This is the picture. The blue line is the excess return on long short strategy. The red line is the p-values. That is when we do the basically CAP-M. If we did Pharma French, you get this. There is a link between predictability and return. Maybe the hedge fund, the long short strategy, didn't do absolutely well as they claimed they could during the crisis, but they did better than S&P. Look, they did better. But then it's the time that inefficiency we're setting in. Notice here, we just get inefficiency. P-value, when p-value go down, market inefficient. When p-value goes up, market becomes efficient. To me, it was amazing. I don't know what you think. I didn't know what to get. Because remember, one data is testing, my statistics I developed, testing whether alphas are significant for each point in time using 500 index. The other one coming from the hedge fund return. And this is the average of hedge fund return, not just a particular hedge fund return. So my conclusion is that this is a very important area of further research. What I've focused on some of the limitation of the Russian expectation of market efficiency. I'm not proposing that the development equilibrium model should be abandoned rather than that we should pay more attention to learning this equilibrium and heterogeneity. Problems of parameter and model uncertainty we need to acknowledge in this literature because there is no reason to believe all of us use the same model even if we have the same data in order to arrive at the forecast. All econometricians know that's not possible. Why do we persist that that's true? And the degree of market efficiency varies over time. It is a complex phenomenon. We need new data, new perspectives. I have other ideas, but we don't have time to talk about, but basically that you need to collect more data on individual traders. And more emphasis should be placed on the use of survey responses, particularly concerning the equilibrium behavior of the traders. And correlated behavior due to herding also needs to have particular attention. So basically, I am suggesting more research in this important line rather than to abandoning the strategy. Thanks so much for listening to me.